Well, hello, everyone, and welcome to today's webinar, Retirement Planning for Business Owners and Employees. Thank you for attending. My name is Brian Schill, and I'm the Executive Director for the Peters Township Chamber of Commerce. Today's webinar is sponsored by Confluence Financial Partners and presented by Mr. Neil Rongus and Mr. Gregory Weimer. Good morning, gentlemen.
Good morning.
Good morning.
Awesome. Little Zoom 101 for everybody. This is being recorded, so it will be available on our YouTube channel for your perpetual viewing pleasure. And also, if you have a question, please use the Q&A button rather than the chat. Again, that's the Q&A button rather than the chat, and we'll monitor them as the webinar goes on. So again, welcome to everybody, and gentlemen, take it away.
Thanks, Brian. And welcome everybody, and thank you for joining us in the next webinar in the series, Financial Success, the simple steps you can do today to help secure your tomorrow. As Brian mentioned, I'm Gregory Weimer, and I'm a wealth manager with Confluence Financial Partners, and I'm joined by Neil Rongus today, who's also a wealth manager at Confluence. Confluence is a wealth management and financial planning organization in the Pittsburgh area with 3 offices, one in the North Hills, one downtown, and one in Peters Township. It will be moving there within the next month. It's currently in South Point, so looking forward to that and getting more involved with the community. And appreciate Brian having us on here. So today we're going to be talking about retirement planning for business owners and employees, and really what that means, and a little agenda is first, retirement planning, food for thought. So we're just going to run through some hot topics in retirement planning. What are the risks that are involved right now? And then I'll pass it over to Neil, who, the second bullet says, so what? And really what we mean by that is, okay, so we could give you all the data, facts, risk, but what does it mean to you and how could you apply it to your life? So Neil will walk through some of those things and talk about some different retirement accounts that hopefully you can get some ideas from. As Brian said, feel free to ask any questions in the Q&A throughout. We'll try to get to some at the end. We should have time, but if we don't get to it at the end, we can absolutely follow up with you too. If you would rather wait, feel free to email both of us also and ask us a question that way. Let's go ahead and get started with some retirement planning food for thought. So quote here, growing old is not an option. We don't have a choice, but we do have choices that will greatly affect our quality of life for the rest of our life. And this is from Getting Started in a Financially Secure Retirement book. But really what this means is, whether you're far from retirement or rapidly approaching retirement, the choices today will impact the future. And so, making sure you're ahead of the game, making sure you're planning early, making sure you're doing the right things, the choices now could impact you when you're 90. So it's not something, retirement often seems so far away, or the age of 85 or 95 seems so far away, but there are things that you have to do decades beforehand, not at the last minute. If you wait until the last minute, you'll be too far behind. And so if we look at this, I have up here a chart that shows the retirement savings gap, and this is from the World Economic Forum. So what this is showing is the dark blue bubbles for various countries, and the US is over towards the right. The blue gap is the 2015 retirement savings gap. So in 2015, there was a $28 trillion retirement savings gap in the US. And the estimate was that would continue to grow by 5% annually until 2050, where it was at 137 trillion. And so we'll talk about more of these risks coming up and then dive deeper on a couple, but the World Economic Forum looked into that and said, well, why is that the case and why is it rapidly increasing? And so there were a few things that they identified that they thought could be key factors. So first, people are living longer, right? And as life expectancy increases, that's awesome. But at the same time, that is putting a strain on people's retirement funds, and it needs to last longer than it did in the past. So that's one thing. The second is the more informal work structure. You have a lot of gig workers now, you have a lot of self-employed people, which creates a lot of freedom, but also changes the picture around retirement because you don't have the typical defined benefit plan pension or a 401k option. There are options available, but people may not be as aware of those. So that's putting people behind. And with some proper planning, it's an easy catch up. It's just some education that needs done when you're not in a corporate environment. The third is a growing middle class. So as the middle class grows, there's more wages, more cost of living, the quality of living is increasing. And so people want a better quality of life when they retire. We see this all the time where people say, well, how much do you typically see people spend once they retire? And to be honest, a lot of times it's the same, right? Especially in the first 10 years of retirement, people still have pretty good health. People want to travel. And so there's a lot of things that you have more time to do. And so in later years, will retirement spending decrease? Probably, but it may not necessarily decrease in the beginning. And so keeping up with that quality of life requires more funds. And then finally, and the World Economic Forum did note that this probably isn't as much of an issue for the US or even the UK as some of the other countries in here, but the underfunding of corporate pension plans could contribute to it a little bit. But in the US especially, there is a lot of regulation around it, so it may not be that bad. So here, we'll walk through these because I think these are all very important, and then we'll dive deeper on a couple of them. But here are some of the risks that retirees are facing these days. So first, longevity risk, and we'll start top right. We talked about this. This is the chance that people just live longer because of life expectancy improvements. And so your retirement funds have to last longer. An interesting stat was that a couple aged 65 currently has a 25% chance that one of the two of them lives at least until age 96. So we'll talk about life expectancy in a minute, but I thought that was an interesting stat on how long people are living. Solvency risk is the next one. We talked about pension plans on the last slide, but the one we didn't talk about is Social Security and Medicare. And we're by no means saying we are predicting that Social Security, everyone's going to have reduced benefits, but as you've probably read in the news, there are potential issues and there could be a reduction in benefits in the future. So it's just something to keep in mind when planning, maybe run a couple of different scenarios of, hey, what if I got the current estimated benefit and what if I got one with a reduced benefit? And just something to keep in the back of your mind. Could be a long time from now. We don't know who they would reduce benefits for or how, but it is a potential option. The next risk, savings risk. And this is underfunding defined contributions account. So when I say defined contribution, I feel like a 401k. So people are not putting as much in, and there's an enormous savings gap. And so we talked about that one also on the last slide. The next one, inflation risk, and inflation has been in the news a lot recently, so you're probably aware of it. The first part of it is somewhat self-explanatory, that no matter what time period you're living in or what the inflation rate is, the inflation can erode the value of your savings and reduce returns as things get more expensive. The one thing that is, if we dive deeper, is healthcare. Healthcare inflation has been rising higher than normal inflation. And when you think about retirement, this is something that often doesn't get thought about enough. So people say, well, here's what I'm spending now. Here's how much my healthcare costs. I'm just going to move this into the future and say, this is how much it will cost. Well, not only are healthcare costs increasing annually by a higher percentage than other things, but you use more healthcare generally when you're older because you need more care. So something to think about when you're planning for retirement. Market volatility risk. I think there's a really interesting graph that we'll show coming up on this, but this is where you don't know what the return is going to be per year, especially when you have a portion or a high portion of your investment portfolio in stocks, because as you all know, there is a lot of fluctuation up and down, but that fluctuation and the sequence of those returns does really matter. So one thing we see people come in and say a lot is, well, I know I have this amount of assets now. I'm expecting to get 6% per year until retirement. I'm going to just run a calculation out, see how much money I will have, and see what spending is. The only issue with that is the sequence of returns is really important, and you will not get 6% every single year. It may average to 6%, but there will be a lot of ups and downs. So we'll look at that more in the future, but in a future slide, but that gets into allocation, and there's a lot of planning you can do there. Next one, retirement spending risk. Somewhat self-explanatory, that what ratio of your current spending are you going to spend in retirement, and is it sustainable? The last one, withdrawal rate risk, and we're going to talk about withdrawal rate next also. But what is a sustainable withdrawal rate for your retirement? You may have heard the 4% rule, so we'll talk about that. But not only is what's the correct rate of withdrawal during retirement, but how should you withdraw? So one thing that people overlook is you could have qualified accounts or retirement accounts, such as an IRA. The tax treatment of that is different than if you just had a brokerage account. And so, or maybe you have cash also. And so how are you planning to be the most tax efficient with your funds and knowing in which year what account to pull from for your living expenses? So as I said, we'll dive into a couple of these deeper. This one we don't need to spend too much time on, but the life expectancy is improving. I do think it's a really important point. So 1 in every 4 65-year-olds will live past age 90. And if you're married, make sure you consider your joint life expectancy when you're planning. The longer you live, the more savings and planning that are required. One thing that people often say is, well, I don't have a desire to pass away with a legacy, whether that legacy could be for charity or future generations. It's just not a desire for everyone, and that's completely okay. And they'll say, well, I want to bounce my last check. Well, the problem with that is timing your last check is really important. And unless you can plan for when you're going to pass away, you need to plan for the potential life expectancy that could be a 30-year retirement. So something to think about there. So if we get into withdrawal rate here, now what this chart is showing you is the vertical green bars are the withdrawal rate that was sustainable in a 28-year retirement period from 1926 to 1990. So for example, this period started, if someone retired in January of 1926 and retired for 28 years, they would have been able to withdraw close to 8%, about 7.5%, and it would have sustained their portfolio. They would not have run out of money. You can see in some years it's a lot less, and some years it's a lot more. So for example, if we look in that middle period during the 60s and early 70s, it's closer to 4%. There's times in the 80s where it's close to 10%. And so the important point here is just that 4%, which is the number you'll hear often, generally is a safe number to use. But once you get above that, there's going to be a lot of periods of time where that wouldn't have worked. And remember, this is based on a 28-year retirement period where, as we're talking about life expectancy increasing, many people are retired for longer than 28 years. So these numbers would have been lower. And Neil, I'm sure you would agree, but we look at these withdrawal rates for a lot of clients on a daily basis. And once you start to get into that high 4-5% withdrawal rate range, the scores in a financial plan just don't look good when you're thinking about the likelihood of success. So we talk about that with clients a lot, and it is different for every single client situation. Some people can withstand a little bit of a higher one than others, but the 4% rule, if you've done any retirement research, is something that's very common to hear, and this is why. Yep. So here is the same withdrawal rate, but just looking at it a little bit differently to demonstrate the effect of a longer retirement period. So this is the same time periods. It took all of those simulations that it ran before and just put them into a little bit of a different format and said, let's try to produce a 90% success rate during those time periods. In those time period planning horizons, what was the sustainable withdrawal rate? So if it was a 25-year planning horizon, 4.9% would have worked. If it was a 30-year, 4.5%. And if it was a 35-year, 4.3%. So you can see that there is a dramatic decrease in the amount you can withdraw as you live longer. And unfortunately, the amount of time you're going to be retired is not something that you can easily plan for. And so 35-year time horizon, just put that into numbers. You could retire at age 60, live until 95. That would be 35 years. this part, we don't want to get too much in. Go ahead, Neil.
Yeah, I was just going to make one note on that.
Yeah.
In that last slide where it says, 4.9 to 4.3, that might not appear like a big difference, but if you're withdrawing 4.9 and it can only sustain a 4.3 or 4% withdrawal rate, and you get into principal, it goes really quickly. We've seen it in financial plans when we're doing them for individuals. I think a lot of people are surprised by that very, very small percentage making such a large impact over long periods of time. So that is, it may not appear to be a mathematical big difference, but it is in financial planning, it's a huge difference.
That's a good point, Neil. It is really a slippery slope there. One thing I should just clarify. So when we say the withdrawal rate of 4%, so if somebody has a $1 million portfolio, that a withdrawal rate of 4% means they could take $40,000 from their portfolio annually. So putting it into dollar numbers versus percentages. So the other thing that shows is, and now people have other sources of income, such as Social Security, some people have pensions, things like that. But when you're thinking about how much your current spending is and how much you could need in retirement, just before you even get into the details, that's just something you could think about of, okay, wait a second, my spending is 100,000 now. How much would I need to get there? So that's kind of the basics. And then you can really dive into deeper planning on how am I going to get there? Let's look at sequence of returns and the like. So the next chart, like I said, we're not going to dive deep into numbers in this presentation, but this shows the 10-year treasury yield, the nominal yield, and the real yield, so after inflation, since 1958. The blue line is the nominal, the gray line is the real. And so if we look in this box up here, we'll see that the nominal yield average since 1958 was 5.9%. The average real yield was 2.26. As of February 28th of this year, the nominal was 1.44% and the real yield was 0.04%. And so the reason I'm showing you this in this presentation is when we think about allocation and historically what people have said a retirement portfolio should look like in creating a hedge against the volatility in stocks, we are undergoing a little bit of challenges right now in helping people think through what that allocation should look like. Because you can see in recent years, the real interest rate does not provide enough value to meet the withdrawal rates that many people want from their portfolio. So you need to have a decent amount of stocks in your portfolio that can generate a higher return, but that also comes with higher volatility. And so there's some things you can do, and we have some planning mechanisms. We call it a bucket strategy with short-term and long-term assets that Neil's going to talk about in a future slide. But there is real planning that needs to be taken there, and it's not something where you can necessarily have the same type of allocation that existed years ago. It may need a little bit of a tweak now. And the other thing is, as interest rates go up, the value of that same bond will go down and vice versa. So they work in inverse. So right now, when we're so low and we're expecting interest rates to creep up, the value of that bond will go down. So it's kind of a double-edged sword. There's multiple issues to think about. Neil, anything to add there on the interest rates?
Yeah, I think just a really easy way to think about, because I think, graphs and treasury yields and real and nominal can sometimes get a little bit confusing. But if you just look at historically over the last 60 years, the 10-year treasury has been at, we'll say, 6%. Now it's at 1.5. So it's 1/4 of historical yields. That's basically saying I need 4 times the amount of money that I have that I needed historically to generate the same amount of interest. That's a lot more money. So to Gregory's point, I think there's this common belief out there that when I retire, I just go ultra secure, ultra safe in my investment portfolio, because I think that's what's been preached, in multiple forums, that you need to just be conservative when you retire. Well, if you don't have a big pile of money to get conservative that generates enough interest for you to live on, you're unable to do that. So again, I think, it's definitely a balancing act. Figuring out the right allocation is something that will help you do. But the days of, going into, bonds the day you retire and expecting those to provide you with your retirement income, they're just not there right now.
Thanks, Neil. So this is the sequence of returns graph that I had mentioned earlier, and I'll take some time to walk through this. But both of these graphs show a hypothetical 50% stock, 50% bond portfolio with an initial value of $500,000 and assume a withdrawal rate of 5% annually adjusted for inflation. So 50%, 50%, 50% stock, 50% bonds, starting value of $500,000, withdrawing 5% annually. The chart on the left that says actual historical return sequence above it is what would have actually happened if someone retired in January 1st, 1973 with this situation. So based on the returns, retiring January 1st, 1973, starting at 500,000 and withdrawing 5% annually, this portfolio would have ran out of money in August of 1994. And you can see how it kind of stays a little bit stable, but decreases with a lot of ups and downs. And then there's just a steep decline down. The second graph on the right reverses the historical return sequence. So the returns that occurred in the year of 1994 until August occurred first rather than last. And then, 1993 occurred second, 1992 occurred third, and then 1973 was the last return. So it flips it. Same average if you do that, but it flips the order. You can see that $500,000, same facts, withdrawing 5% annually, actually increased to 1.75 million over that same time period. And so one situation, actual sequence of returns went to 0% or $0. The other one increased to 1.75 million. And this shows the importance of analyzing what could happen under different sequences of returns with the same average. So I thought this was really interesting to demonstrate. And we, with our planning software that we use, this does this, as I mentioned, and we'll often see some scenarios that are interesting because you'll have one that is just sky high and almost so high that it's unbelievable. And then you'll have a bunch that go to zero, like this one on the left does. Generally, somewhere in the middle is what happens, right? When you, and anytime you run 1,000 trials, there's going to be extremes, but you never know. And so this was an actual one, and this really would have occurred, but all you had to do was flip the returns, and now you had 1.75 million. So I thought that was really interesting. Neil, anything I missed on this?
Yeah, I just it's definitely something that we do with all of our clients when we do individual financial plans. We do sequence of return analysis because I think one of the pitfalls that retirees in planning for retirement can run into is just assuming that nice, neat rate of return of 5 or 6%. And we'll talk a little bit about that, but I think it's somewhat dangerous to just assume that you're going to get that 6%, because again, if you're investing in the equity markets, the returns come in very, very lopsided one year to the next. So your long-term average could be 6, but how you get to that 6 is very different. So that's why it's important to pay attention to sequencing, and we do a lot of analysis. Again, Gregory mentioned we actually run 1,000 different sequences of returns to get a probability that we feel comfortable recommending to a client. And that's again part of what we do with all of our financial plans. So great job, Gregory. Thank you.
Just to recap what we've talked about so far, there's an enormous retirement savings gap, and that exists for numerous reasons. And those reasons also apply to other aspects of a retiree's life. So a lot of risks to think about, whether you're 5 years from retirement or 30 years. There are things that you could be planning for now. You should be careful of your withdrawal rate and really do some planning around that. Low interest rates are having an impact on people's allocation during retirement. And then the sequence of returns does matter. We just talked about the drastic impact that that can have. So I'm going to pass it over to Neil now, who's going to kind of apply this information to you and show you some more specifics on some takeaways that you could have from this.
Yep. Thanks, Gregory. So this is this looks to be a busy chart, but this is basically a chart that illustrates that time matters in the market. And we like to say to clients, time in the market works way better than trying to time the market. So this shows what we call the tale of two brothers, brother A on the left in the green, brother B on the right. The brother A starts investing, we'll just assume into an IRA at 22. He puts $5,500 away and he invests for 8 years. So from the time he's 22 to the time he's 29, never puts in another dollar. So he puts in $44,000. His brother B, actually waits until he turns 29. So from 29, and he actually invests the same $5,500 all the way until he turns 65. So he actually makes 37 investments for a total of $203,500. So actually, brother A puts in what, $159,000 less than his brother B. Brother A actually has more money at the end. And I know that's very difficult to probably comprehend, but that is the power of compounding. So brother A, he basically gets to, he allows his money to compound for, 43 years. Brother B doesn't get the whole 43 years. So that front end of the compounding really matters. So, there's an old proverb that says, when's the best time to plant a tree? And the answer is 20 years ago. And the second best answer is today. So, as advisors, when we're working with, retirement plan participants, employers, our number one recommendation is almost always start early. The earlier you start, the less amount you have to put in on the front end. The people that try to play catch up, all it really does is it increases what they have to put into their accounts to get to their goals. So again, this is just to show the difference of timing and time in the market, and time definitely is on your side. So the earlier you can begin, the better. And again, this is assuming the same exact investments. You could see at the top, it's assuming a 10% rate of return. The math works at 8%. The math works at 12%. Brother A will have more money. I actually, a funny story, I have contractors at my house. I actually ran this test on 2 contractors, and they both said, yeah, brother B has to have more money. And when I showed them the math, they didn't believe me, but they believed me once they saw it. So again, start early if you could start early. So as employers, promote the savings at a very early age.
Yeah, and one thing I'd just add there is that a lot of times, especially when you say start early, people may say, well, I just don't have the cash flow available now. It will get better in 5 years, which is often the case, especially when you're talking about, in this example, a 22-year-old. But I think what this also demonstrates is it doesn't necessarily matter the value. I think as long as you're starting with something, do what you can and increase it later. But doing even a little bit is better than nothing. And even that little bit can compound a lot.
It is, because the math doesn't lie. If you look statistically, what you put into a retirement account between the ages of 22 and 30 actually will make up almost 40% of your account balance when you're 65. So that's a huge chunk. If you miss that, those early stages, that's a huge chunk that you're leaving on the table for retirement. So again, may not be able to afford it, but I think in most cases, once you start deferring some money into retirement accounts, which we'll talk about in a minute, you won't miss it, and it'll become very part of regular everyday life. So the bucket strategy, without getting too in detail, I hope to not make this too complex, but this really talks a lot about sequencing of returns. So what we develop for our clients, either approaching retirement or in retirement, and if you're approaching retirement, we typically start building out a bucket strategy about 3 to 5 years ahead of time. So our goal is to have the buckets ready to implement if needed at retirement. And this is really kind of talking a lot about sequence of returns and market declines and how you really manage through market declines, because this is a strategy that is very defensive for periods of time that are in distress. So perfect example, 2020, everybody will remember it, but from February to March of 2020, the market declined by 34%. In a 33-day period, the market declined by 34%. So if you didn't have a mechanism in place to take your income from a different place in your portfolio, you're really rolling the dice. And what I mean by that is we typically have 3 different buckets in our retired clients' portfolios. We have the long-term, kind of the long-term stock portfolio, and then we have short-term bonds and cash. And the reason they're in there is because they're completely uncorrelated to the market. So when the market goes down, those buckets of money do not go down. So we want to, so in theory, basically what we do is we figure out how much money our clients are going to need from their portfolio. And, you know, again, Gregory mentioned our clients mostly have other sources of income. They have Social Security, they have, you know, perhaps a pension, maybe rental income, who knows, maybe part-time employment. Once we figure out what needs to come from the portfolio, we will typically keep 3 years in reserve of that particular dollar amount in the short-term cash buckets and the short-term bond buckets. And then if we get, and again, I say if, but it's more like when we get a decline in the market of 20% or more, we now no longer take money from the long-term bucket, we take it from the short-term bucket. So I did, in preparation for this meeting, I basically said, okay, if you had $1 million portfolio at the start of 2020, and it was all in stocks, and you were just taking out your, 4%, that's $40,000 per year. Well, February to March, the market declined by 34%. So now your $1 million is worth $660. If you're still taking out that 40,000, now the withdrawal rate's at 6%, not 4%. So this is where the bucket strategy is really important, because it battles sequence of returns, it battles market declines, and it allows our clients to be more long-term in nature and really have the peace of mind to know that they have income on the side when things get difficult. And again, this is unique to every single client. Everybody's bucket's different. And we really take the time to work individually with all of our clients to make sure they have the right bucket strategy in place. So some investment accounts to consider. These are certainly not all of them, but I think definitely the most important and probably the most popular. I'm sure everybody's heard of 401ks. We have traditional IRAs and Roth IRAs. There's also a SEP IRA, which we'll talk about, a simple IRA, and then I think the one that oftentimes gets left out of retirement planning is a taxable account. So we'll go into each one of those in a little detail. So we've probably all seen 401k or 403b. They're the same. So don't let that confuse you. 401ks are sponsored by for-profit companies. 403bs, so if you work for a church, charitable organization, and an endowment, a foundation, those sponsored plans are just a different tax code. It's 403b, but they're, for all intents and purposes, they're exactly the same. The maximum amount that an employee, so for example, I'm an employee of Confluence Financial Partners. They sponsor a 401k. I can put into up to $19,500 of my own money through salary deferrals into the 401k. If I'm actually 50 years old, 50 or older, I can do what's called a catch-up contribution of $6,500 additional. And I think that's just the IRS and the government's way of saying, okay, you're getting a little closer to retirement. If you're running a little bit behind, this gives you the option to sort of catch up and defer more money and build up that account balance for when you retire. And employers often, almost always, provide some sort of company match. So the company match should not be ignored. When we do 401k participant meetings, I'll typically ask a very simple question: who in here does not participate in the plan? And we'll sometimes get a handful of people that raise their hand. And then I ask those same individuals, if you could get 100% rate of return on your money day one, would you take it? And they always say yes. And I say, well, that's what the match is. So if I make $100,000 and I put 3% of my salary away, that's $3,000. If my company matches me 3%, that's another $3,000. If I don't put my 3 in, my company won't match me. So I'm leaving 100% rate of return on the table. And that's, over time, that is significant. So, we really, really encourage A, participation, but B, participation at least up until the match. Because otherwise they're really just leaving benefits that companies provide them on the table. And a lot of times the 401ks, there's also another component to those that are what's called a profit sharing component. So most plans, so if you're an employer out there and you have a profit sharing component to your plan, that's not an obligation. That could be something that's completely discretionary. So, if you have a good year and you have some profits and you want to share those with participants, you can certainly do that. The one thing to note, you can't share it with yourself unless you share it with your employees as well. So that's a 401ks, 403bs are non-discriminatory. You can't put money in for yourself, but not your employee. We hear a lot. I'm sure everybody knows what a traditional IRA and a Roth IRA is, or at least has heard of them. We won't talk about where they make the most sense because that's a whole nother conversation, but a traditional IRA, that is money that goes into a retirement account pre-tax. So again, I'll use the example. I make $100,000. I put $6,000 into my IRA. I am taxed on $94,000. If I don't put any money into my IRA, I'm taxed on the whole $100,000. So it's a tax advantage today. So I'm deferring those taxes. The money that goes into the account, and we invest it in a portfolio. It grows tax deferred, meaning all of the dividends, all of the capital gains, all of the growth of the portfolio is completely deferred of taxes. You don't pay as you go. IRAs are paid, the taxes are paid on an IRA when you start to withdraw money after the age of 59 and a half. So if I take money out, say 60, that money that I take out is actually taxed as ordinary income. I take money pre 59 and a half. We certainly don't recommend that because on top of the income tax, there's also a 10% tax penalty. So if I take out $10,000 at age 45, I pay the income tax and I pay the 10% on the 10,000, which is another $1,000. So those penalties and taxes can really start eating into your nest egg. So we certainly would never recommend pre 59 and a half. Roth IRAs almost work the opposite. So Roth IRA, the money that goes in is actually after taxes. So I get paid, I pay my taxes, I have money left over. I could put that into a Roth IRA. Again, both limits are $6,000 on both the Roth and the IRA. And you actually get a catch-up contribution at age 50 and over on those as well of an additional $1,000. So it's kind of back to the Roth. The money that goes in, again, it's already taxed. It grows tax-free. So again, no dividends are taxed, no growth of the portfolio is taxed. And when I start to take money out in retirement, I actually take it tax-free. So one tax savings today, one is a tax savings in the future. And we oftentimes help clients, in fact, almost always help clients determine what's the best way to do it. If you think about a traditional IRA, most people in retirement are going to be in a lower tax bracket than they are today. So that's where a traditional will probably make more sense. I get a better tax break today, and then in retirement, when my tax bracket's lower, I'm going to pay less taxes on it. So again, that's a little bit of a balancing act, but I will say both very, very good retirement vehicles, and a lot of our clients have them.
So the one thing I'd add there, and we didn't put it on here, and as Neil said, we're not going to get into every single scenario and what makes sense for each person, but there are income limits onto who can get the tax deduction. If you make too much, you get phased out. There are income limits on who can contribute to the Roth IRA. So just make sure you're checking those limits or talking to someone before you do that. And there's some planning you can do there to make sure you're doing it the right way.
Yep. SEP IRA. SEP IRAs are for self-employed individuals, small business owners. SEP is an acronym actually for what's called a simplified employee pension. So there's higher contribution limits to a SEP. So if I'm a small business owner and I make, let's just say $100,000, I can defer up to $25,000 or 25% into my SEP. So for small business owners, the limit is much higher than, say, a 401k. Now, you can't exceed $58,000. So if you're a small business owner that makes $1 million, you can't put 25% or $250,000 into your SEP. There are limits. So the number is actually 25% or $58,000, whichever is the lesser of the two. Again, minimal setup requirements, very easy to set up. Typically, your CPA or your tax advisor will tell you what is, we'll call it the most tax efficient amount to defer into the SEP. Gregory, you'll probably agree with me. We get some really weird types of contributions. They're really odd dollar amounts, and that's basically the CPAs working to sort of maximize tax efficiency for our clients. And again, keep in mind, this is really, I think, more geared towards self-employed, small business owners, maybe with 1 or 2 or 3 employees, because again, what you put in for yourself, you have to put in for your employees. And if you're putting in 25% of your comp, you have to put in 25% of their comp as well. So these can get pretty expensive if you have, a lot of employees, and probably not recommended. Simple IRA, again, another acronym, simple to remember, but it's a savings incentive match plan for employees. Very similar to a traditional IRA. Ideal for small business owners with 100 or fewer employees that don't really want the administrative burden of a 401k plan. So there are employees put money into the plan, and then the employer will match them. Typically, the match is anywhere between 1% and 3%. 3% is the maximum. So they tend to be cost effective for employers, and a really good incentive for employees to A, put their own money in, and B, get the match from the company as well. And again, there are very few setup costs on there, minimal setup requirements. So all of these have different requirements from, okay, how do I set them up? What are the costs? Who am I paying to do this? And that's why there's multiple types of retirement accounts, because depending on the type of organization, you may just want a very simple plan with cost efficiency. And we would certainly advise any business owner or individual for that matter on what would be the best way to go in setting up a plan. And then the taxable investment account. So that's, if you have a spouse or a significant other or partner, this could be an individual account, this could be a joint account. I think these oftentimes get left out of the retirement conversation. and I know Gregory mentioned in his earlier slides, they're very important because the order in which you spend money in retirement from your accounts is important. I think if we were to paint an ideal picture of a client very well prepared for retirement, it would be someone that has a very good balance of retirement accounts and non-retirement accounts. And the reason being is because it really gives you flexibility on how you spend your money, especially in the early years of retirement. So if I retire at 65, I would love to have a taxable investment account that I can draw on until I'm actually required to take money out of my retirement account, my IRA, my 401k. And that mandate, that mandatory age is age 72. So not everybody has enough money put aside to live for 7 years without their retirement account, but some people have enough to live for 2 or 3 or 4. And that really puts them in a really good tax situation early on. So, you know, a couple of the points is, you know, funds can be withdrawn at any time. So there's no penalties, and there's no contribution limits. You can actually put whatever you want into a taxable investment account and take it out. The difference is it's taxed. So the taxable amount is based, you know, if I have an investment account with my wife, and I get dividends, so my portfolio generate dividends. I get a 1099, pay tax dividends. Whereas remember in the IRA, I don't pay taxes on those. If I have stocks in my account that I sell, and I sell them for more than what I purchased them for, I pay a capital gains tax on the difference. So again, you don't get that tax deferral, but the trade-off is you have complete flexibility of what you put in and what you take out. So again, taxable investment accounts should certainly be, should not be ignored. It should be viewed as a very important factor in, you know, efficient retirement planning.
So here on this one, just another reminder to, you know, make sure you're reviewing a financial plan. It's about the investments and the financial plan. You know, gain an understanding of your current path, and then look at potential adjustments. Should you save more? Do you need to save more? Do you need to adjust your retirement age? Maybe you need to adjust it back to make sure you have enough for retirement, or maybe you realize, you know what, I could retire earlier. You start to weigh the pros and cons of working a little longer versus spending or having a different legacy. And then what's the investment allocation to meet your retirement goals and the retirement age you want to retire at? Are you able to be more conservative? Should you be a little more growth oriented? So a financial plan is really important. It is really hard, and you are running some risks if you just get an investment portfolio and say, well, I want to get it to $1 million by the time I retire and I'll be good. You can live off that. There's a lot more to think about than that. It should be more than a calculator, you know, a calculator. And we'll actually get into this in the next webinar, but the financial industry has evolved over time. And so it's more than a calculator. It's a full comprehensive plan that is really what everybody is realizing needs done, and that we typically work with our clients on.
Yep.
Go ahead, Neil.
Yep, I was just going to say, and it's a plan that that requires updates. It's not a plan that you set and forget. It's you know, things evolve, your goals change, people's lives change, and your plan should reflect that. So that's why we have a very regular process of making sure we review our clients' financial plan with them at least annually. And we don't see big changes from one year to the next typically, but if you look at someone's financial plan today and you looked at it 5 years ago, it's almost certainly different. So to start planning is certainly one to do, but to update that and make sure it's maintained over time, to make sure you're on track to do what you want to do, because ultimately your retirement plan, your money, it's there to provide the things that you want to do and maximize your life, maximize your legacy, and ultimately do the things you want to do after you no longer work.
Exactly. So, and before we wrap up and summarize, I did see a question just come through. So the question was, would the Robinhood platform be an example of a taxable investment account vehicle? And yes, Robinhood would have that option for a taxable investment account where you're just saying, hey, I'm going to put $1,000 into here and I want to buy these couple of stocks. You could take it out tomorrow if you wanted to. If you have any gain, you would pay tax on it. If you left it in there and there were dividends over time, you would pay tax on the dividends. That would have that potential.
Yep.
So what we talk about today, as a reminder, we went through some food for thought and some of the risks around retirement that we should be thinking about these days. And then we tried to make it applicable to you. So what are the retirement accounts you should be thinking about? What are other ways that you can save? What is the power of starting early? Hopefully this gave you some ideas for your own personal life. If you have any questions, we'd love to answer them. Feel free to put them in the chat. Feel free to follow up with us after. And just so everyone is aware, we do have another webinar next week on Wednesday at the same time. We'll be talking a little more about goal-oriented financial planning. So we throw around financial planning a lot, we throw around goals a lot, but really, how do we think about that? How do we think about people's goals? And how do we determine really what is it all about? Because until you put meaning to that pile of money, it's really just a pile of money. So how can we have those conversations to help you think through that? Finally, like I said, if you have any questions, please reach out. We would love to help. We'd love to answer any questions, whether it's just a conversation or you're looking for some assistance with your finances. We like to say, as Neil said, we want to maximize your life and legacy. We work with business owners and we have a corporate services department. We work with individuals, self-employed people, families, young people, retired people. So happy to help. Our goal is just to help as many people and families as possible. At this point, if there's any questions, I'd love to open it up. And if not, we can follow up later.
Here's another question for you guys. This information seems somewhat complex for someone like me. What do you recommend that I should do?
Yeah,
I'm guessing they're probably not the only ones either. The person.
Right.
No, you bring up a good point. I mean, it could be somewhat intimidating because I think our goal is to not make everybody experts in finance, right? Our goal is to make sure that we help clients sort of think through what we'll call it, what their why is. What's it all about? What do you want retirement to look like? Is it, not just I want to retire at 65 with $50,000 of income. That's a calculator, right? We want to help clients really think about, moments with their families and travel and, possibly philanthropy and how they want their money to pass to the next generation and the values that they pass on to the next generation so that they make sure that, their kids and grandchildren's, that, they share the values and spend the money the way they want to spend it. So, I think to try to look at all of this and say, okay, I don't understand all those different accounts because we'll never do that in one webinar. I think the next step would be, okay, I want to make sure that I'm secure for retirement. What do you guys recommend? And that would be more of an in-depth conversation about, your individual wants and needs. And then from there, we would start to recommend the different vehicles to get there.
Yeah. Yeah, and I just piggyback on that to say, don't hesitate to reach out, right, at any point. I think a lot of times people aren't sure what to do, so they just freeze and do nothing. And don't hesitate to reach out. There's people out there to help you. We talk to people every day about this type of thing, so we're happy to help, and just don't hesitate.
Thanks. I did note a couple things. The one, I love the tale of two brothers. It's amazing. I'm a retired Air Force pilot, so we like pictures. Not necessarily a lot of graphs and things, but that graph and that picture, that says a lot. it's amazing. And even when Neil, when you followed up with the 4.9 versus the 4.3, I was one of those people that said, it doesn't seem like that much difference, but I'm great. You pointed out, the difference between those two. And then the last thing, I would just like to say thanks, because you guys have been real community minded. You're offering for folks to reach out, even if they're not current clients. And that's huge, because I think that is a huge step for people who may be afraid, or who just aren't sure. The fact that, they got, there's no commitment, but they can ask you guys for questions. And I really appreciate that. So good.
Absolutely.
But yeah, thanks again. I appreciate it. And like Gregory said, next Wednesday, we'll have the goal-oriented financial planning, same time at 10 o'clock. You can register for that at ptcoc.org. Thanks again, Neil and Gregory and Confluence Financial Partners. We really appreciate your support. And thanks to all of you as well. Stay well and have a great day.
Thanks, Brian.
You too.